G'day again everyone, welcome back to another update for natural gas. Now the daily and hourly charts have turned bearish. We'll go through those in a minute, plus we'll include some back testing. Make sure you hit that like and subscribe button to support the channel. First, looking at the outlook as of today, April 2nd, for BOIL as a leveraged ETF aiming for twice the daily performance of the Bloomberg Natural Gas Subindex, suitable for short-term strategies due to its amplified exposure. For KOLD, provides twice the inverse daily performance of the same index, allowing investors to profit from declining natural gas prices, also intended for short-term use. UNG tracks daily changes in natural gas spot prices through near-month future contracts, offering direct exposure without leverage. In terms of AI data processing and geopolitical events, the rapid expansion of AI and data centers is significantly increasing electricity demand. Projections indicate that by 2030, data centers could consume up to 12% of total US electricity, up from 3 to 4% in 2023. Natural gas is expected to supply a substantial portion of this increased demand, with estimates suggesting it will account for 60% of the growth, equating to a 10% rise in natural gas consumption by the power sector by 2030. This trend underscores a critical role of natural gas in meeting the energy needs of the burgeoning AI industry. So we first look at the long-term trends, and on the monthly and weekly we're still bullish, with the CCI and the price above their respective moving averages on both the monthly and weekly. So bullish momentum on those charts. On the daily, however, we've actually broken down, and after hitting this resistance up here at 49.30, it's now bouncing off this minus 39.45. But notice the CCI is still dropping. Made a bit of a bounce there, but it's still dropping below the moving averages. That's indicating a bearish momentum. So just be cautious about trying to go long. We're predominantly short positioning on the lower time frames. If we go to the intraday charts, the 1 hour chart, you can see here we're going short again in the direction of the daily. So you would have been wise to take short positions from there when the CCI and the price broke below the respective moving averages. Notice here as well, we did have a slightly almost double top on the CCI versus a higher high on the price, and that's a bearish divergence, and it actually broke down quite substantially. And if I was to draw a Fibonacci from that high to that low, you can see there it's broken below the 50% level and approaching the 61%, which is also corresponding to this minor support at 39.45. So as far as backtesting goes, I've got the short backtests here for the stop loss approach and the average down approach. These are the profitability charts for each, and we would have taken short positions from that period back there when the price broke below the moving average, and so did the CCI. That's indicated by this period back here. And what I've done here, I've marked it with a cross, indicating where you should have exited the trades, even if you're holding positions. And why did we do that? Again, we always pay attention to the divergence. So you can see there in this smaller divergence there were higher lows on the CCI versus lower lows on the price at that first trough there on the price and that trough there on the CCI. So you would have got out of the trade somewhere along there. Once you started seeing the CCI rising and the price still falling, that was a bullish divergence. So if you're going short, you want to get out of the trade. So you would have got out of there with the stop loss approach with approximately $895 gain, and the average down approach, even though you're holding a few contracts there, you would have got out with $3,745 in gain. So always pay attention to the divergence. Don't just blindly go with the trend of the daily and get out. For example, had you got out there, you can see there at this point here, you would have been in the red on both the stop loss approach and the average down approach. So for BOIL on the monthly, still bearish. It's below the moving averages of the price chart. There's no CCI for it. We'll consider that a bearish move. On the weekly, however, we had this bullish divergence, higher lows on the CCI versus lower lows on the price, and that eventually bounced through that moving average range, and we would have got in somewhere in this point there if you were trading on the weekly. On the daily, we hit this resistance up here at 107.11, and it's broken down since then, and you'll see there the CCI broke down as well. It was a leading indicator compared to the price, but that also had a bearish divergence there, lower highs on the CCI versus higher highs on the price. And had you been going long during this period and you saw that peak there, the second peak on the CCI versus the price, you would have started taking your profits off the table and getting out of the trade of long positions. Now since then you'd be going short only. Now if we go to the intraday chart, again taking short positions only, you can see there along this period, short entries, until you saw this bullish divergence. So had you been going short and you saw this bullish move, higher lows versus lower lows on the price, you would have taken your profits and got out of any short positions. Now, in terms of rebounds or retrace, we draw a Fibonacci. I usually take it back to the previous low. You can see that it's broken above the 61%, but even if you take it back to that significant high there, it's actually still broken above the 38% level, which is and our minimum range is at 23-38% range. Now you'll notice as well it's retraced back to the downside and still bearish at the moment, so bearish trades only to be taken at the moment. In terms of backtesting for BOIL, what I've done here for the backtest, I've started this at this point here around the 15th of March, which happened to be this point here when the price broke below the moving average range, and so was the CCI. That's indicated by this point here. And the stop loss approach since then has generated $95. We're trading about $1,000 per share, and this one has generated $214. So we had a few entries there on both the stop loss approach and the average down approach. But again, notice here with that bullish divergence on the CCI versus the price, you would have stopped taking short trades from that point on, so you would not have got into any more trades. So for KOLD, it's the inverse. We've got here on the monthly, it's broken below the moving average range, still bearish. There's no CCI for it, or it's just starting to build. On the weekly, bearish momentum, likewise on the CCI, and notice it's approaching the moving average band and still turning down, so potentially more downside to go according to the weekly. And on the daily, again predominantly bearish momentum, except we had this bullish divergence similar to the other charts versus lower lows on the price, and it's bounced from there, and that CCI is still trending up, and the price is finally broken higher. Now I've drawn a Fibonacci target range here to this high there, and you can see there it's a bit of a way off from that 23% minimum target, so it may not actually reach it, but it also depends on where you draw this Fibonacci range. So if I drew that, so let's go back to I usually take it back to the point before that divergence started, and that would have been the point there. So you can see there it could have, and it still failed to hit it had it been that point. Now that notice the CCI and the price is still rising potentially, so just be cautious of that. We might still see further upside, in fact, hitting this range. So again, I'll keep that there and see how it goes in the coming days. Now if we go to the intraday chart, again predominantly bullish momentum at the moment, and you'd be taking long trades at the moment. It's a fresh breakout, so not much gains to be made, but that would be a fresh breakout going long at that point. But notice also the CCI is breaking down a bit, so cautiously going long. Yeah, just be mindful of that. There's no guarantees, of course. This could keep rising, as we said, to that target range. I don't normally trade these divergence. Take advantage of that possibly, but again, I'm not telling you to do that. Every trade is a risk, but you've got to try and use probabilities of success as much as possible that we're demonstrating. Lastly, for UNG on the monthly, it was bearish, but notice it's got a fresh breakout on the price chart, just above those moving averages. Although this month so far it's a bearish candle. The CCI broke above a couple of months earlier, so giving us a somewhat very slight bullish momentum on the monthly. The weekly is still bullish, and that was after this bullish divergence we had back there starting in 2023 versus lower lows on the price. It broke higher and still going in a bullish momentum on the weekly. On the daily, hit this resistance up here at 24.13, broke down. The CCI gave us an early warning of that, and so did this bearish divergence. So you would have avoided taking any further or close your positions on long positioning at that point if you're trading on the daily, and taking advantage or taking notice of that bearish movement, bearish divergence. Going to the intraday chart, again predominantly short trades to be taken. That would have been from that point there when it broke below on around the 17th of March, and you would have taken no short trades. But notice here we've got a bullish divergence versus lower lows on the price. As soon as you see that, if you're going short, take your money off the table, take your profits, and wait for another opportunity. So that other opportunity would possibly be from this point on. You can see there on the hourly, if you're trading the hourly, the price is broken below, and so does the CCI, so that could be a fresh short position. So this is a back test for UNG, again taking short trades on the hourly based on the daily momentum, and that started from this point on when the price broke below the moving average range, and so did the CCI. This is the stop loss approach, had a few trades there, and the average down approach with less trades entered. Now, again, you'll notice we had this bullish divergence. So you would have been, as soon as you saw that difference in a higher or almost a double bottom on the CCI versus lower lows on the price, around this point here, you would have taken your profits off the table. So the stop loss approach generated $33, and the average down approach generated about $40. So again, just pay attention to the divergence if it's going against you. So again, based on our strategy, if you're going short, again, you would have closed it out at that point, but you would have re-entered once that CCI and the price broke below the moving averages, because the daily's in a fresh breakout as well to the downside, a short positioning, and that's where your fresh breakout would have been on the hourly. So you would have taken your first or your next trade at that point there for both the average down approach and the stop loss approach if you're trading that one. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3, you got a total of 3 contracts now running, add another 4, you got a contract, 7 contracts running, add another 8, and then you got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest 1 contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.